Hello, all my dear students. I am Miss Shweta Shrimali. Today we are going to talk on the topic of marginal costing from third year of commerce. Thereunder, we are going to see the practical examples more on related with the marginal costing. So let us understand with the recap. In our previous session, we have already discussed about the calculation of break-even point. Thereafter, the calculation of profit to volume ratios and the calculation of margin of safety. In this today's session, we are going to talk on the practical examples on change in profits as well as change in sales. So, this is the example number 1. Sunny Limited, Gurgaon has prepared the following budget estimated for the year 1920, and they have given us the following information like sales 15,000 units, fixed cost rupees 34,000, sales value rupees 1,50,000, variable cost per unit rupees 6. And they required us to calculate first PV ratio, BEP sales and margin of safety, and second calculate decrease of 10% in selling price and increase of 10% in variable cost. So let us understand how to solve this example. So firstly, what they required us to calculate is the PV ratio. So for calculating the PV ratio, formula is contribution per unit upon selling price per unit into 100. While calculating this, we have to calculate first the selling price per unit. How will you calculate the selling price per unit? It is calculated by sales value divided by number of selling units. In our example, the sales value is rupees 1,50,000 and divided by the number of units, that is 15,000 units. So our selling price per unit comes as rupees 10. The next calculation is contribution per unit. But for calculating contribution per unit, we know the formula, that is selling price per unit minus variable cost per unit. We have just calculated the selling price, which is per unit, is rupees 10. So rupees 10 minus variable cost per unit is rupees 6, which is already given in our example, and hence our contribution comes as rupees 4. When we will put these figures into our formula for calculating the PV ratio, the formula is contribution per unit, that is rupees 4, upon selling price per unit, that is rupees 6 into 100. And by solving this formula, we will get our PV ratio as 40%. Thereafter, the next calculation is of BEP in sales. We know the formula for calculating BEP in sales, that is fixed cost upon PV ratio. In our example, the fixed cost is given as rupees 34,000 and we have just calculated the PV ratio is 40%. So rupees 34,000 upon 40%, so the BEP sales is rupees 85,000. The third calculation which is required is margin of safety, which is known as actual sales minus BEP sales. So we have actual sales of rupees 1,50,000 and just calculated BEP sales, that is rupees 85,000. So margin of safety is equal to rupees 65,000. After that, they required in the B category, that is if we decrease the selling price by 10%. So the calculation is original selling price per unit minus decrease of 10%. In our case, the original selling price is calculated by us, it is rupees 10 minus 10% of rupees 10, which will come as rupees 1. So our new selling price will be 10 minus 1, which is equal to rupees 9. So we will put this rupees 9 as a new selling price and we will recalculate the formulas like first again PV ratio, so contribution per unit upon selling price per unit into 100. So again we have to calculate new contribution per unit which will be new selling price per unit minus variable cost per unit. So we have the new selling price per unit we have calculated as rupees 9, and in our example the variable cost per unit is already given, that is rupees 6. So contribution per unit is equal to rupees 3. We will put these figures into our formula and we will get the PV ratio. So rupees 3 upon rupees 9 into 100, and the PV ratio comes as 33.3333%. In this way, we will calculate our BEP sales also. So the formula for calculating BEP sales is again fixed, that is fixed cost upon PV ratio. In our example, we already known our fixed cost is rupees 34,000 and divided by PV ratio which we have calculated, that is 33.3333%, and the BEP sales we got is rupees 1,02,000. Now in again second part, they required us to calculate margin of safety, which is known as actual sales minus BEP sales. So in our example, we have the actual sales of rupees 1,50,000 and just calculated BEP sales, that is rupees 1,02,000. Hence the margin of safety comes as rupees 48,000. The second part, which is where there is increase of 10% in variable cost. So we have the original variable cost with us plus 10% increase. The original variable cost is rupees 6 and into 10% of it, that is 0.60. So new variable cost comes as rupees 6.60. Again, while calculating the contribution per unit, we require the formula which is known as selling price per unit minus new variable cost per unit. Our selling price per unit is rupees 10 minus just calculated variable cost per unit is rupees 6.60. So the new contribution comes as rupees 3.40. So again we will put these figures into our formula. PV ratio is equal to rupees 3.40, which is our contribution per unit, upon rupees 10, which is our selling price per unit, into 100, and the PV ratio comes as 34%. Thereafter again next calculation is of BEP sales. So again fixed cost upon PV ratio, that is rupees 34,000 upon 34%, which is equal to rupees 1 lakh, and last calculation is of margin of safety, which is again actual sales minus BEP sales. So rupees 1,50,000 minus rupees 1 lakh is equal to rupees 50,000. So in this way, in this example, we have calculated the BEP PV ratio as well as margin of safety. Also we understood how to calculate the BEP PV ratio and margin of safety when there is a decrease or increase in selling price per unit as well as in variable cost. Thereafter, let's move towards the next example. From the following cost data related to Maxwell India Limited, you are required to calculate first BEP units and sales, and second sales required to earn a profit of rupees 54,000. They have given us the selling price per unit, that is rupees 18, contribution per unit is rupees 6, and fixed cost rupees 84,000. So let's calculate first, that is BEP in units. What is the formula for calculating BEP in units? Fixed cost upon contribution per unit. So we have already given our fixed cost, which is rupees 84,000, upon contribution per unit, that is also given, which is rupees 6. Hence BEP units are equal to 14,000 units. Thereafter next is BEP sales. So for calculating BEP sales, the formula is fixed cost upon PV ratio. In our example, we have the fixed cost, but we will require to calculate the PV ratio. What is the formula for calculating PV ratio? Is again contribution per unit upon selling price per unit into 100, that is rupees 6 upon rupees 18 into 100. So PV ratio comes as 33.3333%. Now again, while calculating BEP sales, we will put this PV ratio in the formula the formula is fixed cost upon PV ratio. So our fixed cost is rupees 84,000 and we have calculated the PV ratio as 33.3333%. So BP sales comes as rupees 2,52,000. Second is sales required to earn a profit of rupees 54,000. While calculating this, we know the formula, that is PV ratio is equal to fixed cost plus profit upon sales. Fixed cost plus profit is also known as contribution, but we required to calculate the sales when there is a given desired profit. So when in the example they have asked us to calculate the sales when desired profit is given, this formula is used, which is fixed cost plus profit upon sales. So in our example, we have the PV ratio as 33.3333 and the fixed cost is rupees 84,000 plus the desired profit which they have required to calculate is 54,000 and required sales. By cross multiplication, we can solve this. Sales is equal to the addition of 84,000 plus 54,000, which comes as rupees 1,38,000 upon the PV ratio, that is 33.3333. So the new sales comes as rupees 4,14,000. In this way, we have calculated the BEP units, sales, etc. This is the next example. Jindal Company Limited, Jamnagar, provides you with the following cost details. Non-variable cost rupees 2,000, variable cost of sales 60%, total turnover 10,000, net margin rupees 2,000, and they required us to calculate break-even sales, sales volume to earn a profit of 6,000 as well as margin of safety when sales are rupees 25,000. Let's solve this example again. As variable cost of sales are 60%, the PV ratio will be 100 minus 60%, which is equal to 40%. When variable cost of sales is given in a percentage, we can calculate our PV ratio by deducting this variable cost percentage from the sales, that is 100%. So when there is no any figures are given for calculating PV ratio and only percentages are given, like variable cost 60%, in that case when the variable cost is there, the PV ratio will be 100% minus the percentage of variable cost, which is known as 100% minus 60%, which is equal to 40%. Thereafter, now for calculating the break-even sales, again the formula which is same, that is fixed cost upon PV ratio. So fixed cost is already given, that is rupees 2,000, and we have calculated the PV ratio as 40%. Hence the new break-even sales are rupees 5,000. Thereafter, sales volume to earn a profit of rupees 6,000. In the previous example also we have solved this, where PV ratio is equal to contribution upon sales, but contribution is equal to fixed cost plus profit. So we can say that contribution is nothing but fixed cost plus profit. So new PV ratio is equal to fixed cost plus profit upon sales, and hence we have the figures. We will put these figures in the formula. PV ratio, that we have 40% and 2,000 plus 6,000, and sales is equal to rupees, which will come as 20,000. By cross multiplication, we will get our sales of rupees 20,000 when there is a desired profit is given of 6,000. Thereafter, they required us to calculate margin of safety when sales are rupees 25,000. So for again calculation of margin of safety, we know the formula. Margin of safety is equal to actual sales minus break-even sales, and in our example actual sales are already given, which are rupees 25,000, and we have just calculated the break-even sales of rupees 5,000, and the margin of safety comes as rupees 20,000. So in this way we can understood this example. Now this is the practice session for you, which is that the following information is obtained from Big Brand Limited, Bandra for the year ended 31st/2020. Sales are given of rupees 1 lakh. Marginal cost is 60,000. Fixed cost is also 30,000. And you are required to calculate the PV ratio, break-even point, sales and value, as well as sales to earn a profit of rupees 15,000. So first of all, you will calculate the PV ratio by using the formula, and first of all you will require to calculate the contribution. After that you will put these figures into the PV ratio and you will calculate the examples. This is a pre-cap. We will discuss some more practical examples on marginal costing. Thank you.